Options trading sounds complicated, right? Like you need a PhD in finance just to get started. Well, what if I told you we could break down the whole thing in the next few minutes using a simple story about buying a house? Let's do it.
Yeah, seriously. To get how options work, we're going to completely forget about stocks and Wall Street for a minute. Instead, we're just going to focus on a single house. Trust me, this little story is the key to unlocking everything.
Okay, so picture this. There's a house for sale, and the asking price is $200,000. Pretty straightforward. That's our starting point.
But here's where it gets interesting. You have a really strong feeling about this house. You think its value is about to go through the roof. The problem? You don't want to drop the full 200 grand right now. Maybe you don't have it, or maybe you just don't want to risk that much capital all at once. So, what do you do? How can you get a piece of that potential profit without buying the whole thing?
And this is the brilliant part. You go to the owner and you make them an offer. You say, look, I'll give you $10,000 today. And for that $10,000, the owner gives you the right, and this word is so important, the right, but not the obligation, to buy their house for that $200,000 price anytime you want in the next 2 years. So that price is locked in for you, even if the house's value skyrockets.
Okay, so what just happened here? Well, believe it or not, you've just perfectly described a financial contract. That whole deal for the right to buy the house? In the stock market, we call that a call option. And with that, you already understand the basics. Let's peel back the layers.
So a call option is really just a bet that something, a stock in this case, is going to go up in price. You're paying a small fee for the privilege of locking in a purchase price today, hoping that you'll get to use that right when the actual market price is way, way higher.
And this is where it all clicks. Every piece of our house story has a direct translation in the world of options. That locked-in price of $200,000, that's your strike price. The 2-year deadline you have, that's the expiration date. And that $10,000 fee you paid for the whole deal, that's called the premium. See? Strike price, expiration date, premium. You've just learned the core language.
Okay, before we go any further, there is one golden rule you absolutely have to know about stock options. It's simple, but it trips up so many beginners. One options contract always represents 100 shares of a stock. Always. So if you see an option price that says, say, $5, the real cost to buy that contract is $500. You just have to multiply by 100. Don't ever forget that.
All right, so we've got call options down. That's your play when you're bullish, when you think the price is heading up. But what about the other side of the coin? What if you're convinced the stock is about to tank? Well, there's an option for that too, and it's basically the exact opposite of a call.
It's called a put option. It's super simple. A call gives you the right to buy. A put gives you the right to sell at a set price. So if you're bullish and think the price will go up, you buy a call. If you're bearish and think the price will go down, you buy a put. Up, call. Down, put. That's it.
At this point, you might be wondering, okay, this is cool, but why not just buy the stock? And the answer comes down to one single, incredibly powerful word: leverage. This is the real reason people are so drawn to options. It's all about getting huge results from small price changes.
Let me show you what I mean with a real-world example involving Tesla. So picture a trader who was really optimistic about Tesla stock. Instead of shelling out a ton of cash to buy the shares outright, they decided to buy a call option instead, using a much, much smaller amount of money.
Now check this out. The stock itself went up by a nice solid 3%. Good, but not earth-shattering. But the option, that same 3% move in the stock price, translated into a massive 15% gain for the option. That is a 5x amplification. That is the power of leverage.
So let's just formally define that. Leverage is simply using a small amount of your money, that premium we talked about, to control a much larger value asset. It's like a financial magnifying glass for your returns. And while that sounds amazing, you have to remember, a magnifying glass works on the way down, too. And that brings us to the most important part of this whole conversation. That incredible potential for high rewards, it doesn't come for free. There's always a trade-off, and in the world of options, that trade-off is risk.
Let's go back to our house story to see how this works. Let's say you were right, and the house price explodes to $350,000. Awesome. You use your right to buy it for the locked-in $200,000, and even after your $10,000 fee, you've made $140,000 in profit. But what if you were wrong? What if the house price crashes to $150,000? well, your right to buy it for $200K is now totally useless, right? So you just do nothing. You let the deal expire. And what's your total loss? Just that $10,000 fee you paid up front. Your maximum loss was known and capped from day one.
Okay, so let's just do a quick lightning round recap. What are the absolute core takeaways? First, options give you the right, not the obligation. Super important. Second, calls are for when you think the price will go up, puts are for when you think it'll go down. Third, they offer incredible leverage, which can amplify your gains. And finally, and maybe most importantly, when you buy an option, your maximum loss is always limited to the premium you paid. That's it. It can't be more.
So in the end, an option is more than just a contract. It's really a debt on the future. It's a way of paying a relatively small fixed price for a chance at a massive payoff. It's a ticket to the game. And the question that leaves you with is a pretty personal one. For that shot at huge returns, what price are you willing to pay?